Hello, we are Group 4. In this video, we will discuss about Murabaha and Musharakah. Before that, I would like to introduce my group member. First of all, I am Lydia Sarini. Group 4 consists of 8 members, including myself, which are Muhammad Yasin, Shafiq Aiman, Elisa Afika, Razi Vikmal, Jennifer Vanessa, Najah Sofia, and Nur Aina Inani. This video will explain the definition, types, and structure of Murabaha and Musharakah in the introduction. The second part will explain about the advantages. Meanwhile, the third part will show the comparative analysis between the Islamic banking system and the conventional banking system. Next, the fourth part will tell about the issue faced by the Murabaha and Musharakah. Not only that, we will also explain about the progress and new update that happened to Murabaha and Musharakah. Lastly, we will also state some recommendations and make a conclusion to conclude all of it. Now, let's start with the presentation.
Hi, I am Najah Sofia Alia binti Harisin. Matrix number 80325 will talk about what is Musharakah and Murabaha, its types and structure. What is Musharakah? In Islamic finance, the concept of Musharakah refers to a joint venture or collaboration where partners split a company's gains and losses. Islamic law prohibits benefiting from interest in lending, so Musharakah enables those who finance of a project or enterprise to obtain a return in the form of a percentage of the real profits with the specified ratio. The Arabic word for Musharakah is Shirkah al-Amwal, which translates to participation or sharing. Major purchases and real estate acquisitions are the examples that mostly financed through Musharakah. There are 4 types of Musharakah, which are Shirkat al-Inan, Shirkat al-Mufawadah, diminishing Musharakah, and permanent Musharakah. Shirkat al-Inan means partnership of trust. The partners are not held individually responsible for each other's debts. This kind of collaboration is often utilized by startups or for financing a project. Next, Shirkat al-Mufawadah means partnership of equality. All partners in Shirkat al-Mufawadah need to invest the same amount of money and later split the gains and losses evenly. Big companies often use this kind of partnership for long-term financing. Diminishing Musharakah is one in which a single partner's capital contribution slowly decreases over time while the other partner's portion rises. The purchasing of a home or any other asset is frequently financed through this kind of partnership. For permanent Musharakah, long-term finance frequently use this method as this agreement has no expiration date and will remain in effect until the partners opt to dissolve the partnership. Moving on to Musharakah structure. Musharakah structure serves as an outline to guide financing and funding and emphasize risk and sharing profit. Next, Musharakah partnership structure gives the partners flexibility on how to handle and allocate the money appropriately. Additionally, the Musharakah partnership structure also allows for partners to have authority in managing the company's money. There are many different kinds of Musharakah structures, and it is advisable to choose one based on what the company wants in a commercial purpose. Next is Murabaha. What is Murabaha? Murabaha comes from an Arabic word rib, which means profit. It's a cost plus financing or a markup. It is the well-known and one of the typical kind of financing in Islam. Murabaha is basically a contract when a good is sold to generate profit. In this contract, seller has to reveal to the customer both his asking price and the profit he expected to make. In order to survive, the financial institution need to make money, hence they cannot lend money at zero interest. However, in Islamic finance, using the Murabaha form of financing, financial institution will buy the commodity in cash, who then sells it to the consumer to gain profit. The client then can purchase the good on a deferred payment arrangement. As a result, the client receives the good for which he had requested financing. Thus, the Islamic financial institution will earn a return on the money it had spent to buy the good. Murabaha is divided into 2 types of deferment. Deferment arising from future, or also known as deferred settlement of sale price, and a deferment arising from future delivery of goods. Murabaha with deferred settlement is the most typical type of Murabaha, as it is practically an instant transfer of ownership, will reduce risk to the seller. Seller, which is bank, will buy the items into its ownership before selling it swiftly to the buyer. Once the debt has been issued, ownership passes from financial institution to the clients and begin to pay back based on the agreed sale price. This deferment is classified as debt-based structure, where bank simply retains the credit risk of the debt or the risk that the client is unable to pay the sale price at the future date as agreed. Next, the deferred delivery of goods refers to when the seller makes a quick buying on the items but delaying a sale with the buyer until far later. Compared to the sale price settlement deferral stated above, this framework is riskier. Up until the products are sold at the sale price that includes profit, the seller will bear the ownership and value risk. The ownership of the products is transferred upon payment of the sale price in full at the time of contract, either through a Murabaha contract or a Musawamah simple sale transaction. Due to the risk of the aforementioned, the buyer typically needed to make an agreement through undertaking letter in favor of the seller to enter the sale contract. Murabaha is known with two frameworks which are based on buy-in transaction and tawaruk transaction. In Murabaha structure based on buy-in transaction, the special purpose vehicle SPV purchases an asset at the moment of issuance directly from the company rather than from a third party. The SPV later sells the identical assets to the company once more at a higher deferred price. However, the accounting and auditing organization for Islamic financial institution banned this strategy. For an example, Sunway City, a Malaysian property developer, is an example of a buy-in Murabaha suku. Since there is no SPV used in the arrangement, Sunway will be suku's issuer. On October 10, 2007, Sunway gained permission from SC to use the medium-term note program to issue 500 million in Murabaha suku. Moving on to tawaruk transaction, which is more popular and it is accepted by the Islamic banking world. Hence, it is widely used by financial institutions, especially in Middle East and Malaysia, unlike the buy-in transaction. In tawaruk transaction, the products used must have a real and legitimate use for the purchaser. The contract shall be deemed invalid if the mentioned conditions are not fulfilled. Tawaruk exists to help customers to solve the issues in order to prevent customers from switching to a riba-based facility to satisfy their needs.
Hello, I am Muhammad Yassin and I am going to be presenting about the advantages of Musharakah and Murabaha. Musharakah, a form of Islamic financing, offers several advantages to both Islamic banks and economic operators. These advantages contribute to the overall benefit of the customers, individuals, or partnership involved. Let's explore the key advantages of Musharakah. First of all is investment diversification. Musharakah financing allows for the diversification of investment portfolios. By participating in multiple Musharakah partnerships across various business or sectors, investors can spread their risk and gain exposure to a wider range of investment options. This diversification enhances their financial portfolio and potentially increase their returns. Secondly is increase the capital for Islamic banks. The Musharakah contract enables Islamic banks to invest more and increase their capital over the medium or long term. Partnerships formed through Musharakahs encourage the focus on capital maintenance and careful management of financial resources. The shared responsibility for the company's success leads to risk minimization and the preservation of the invested resources value. By increasing their capitals, Islamic banks strengthen their financial standing and promote economic operations in line with Islamic principles. This enhances the bank's stability and resilience, ensuring its long-term viability. Moreover, Musharakah also offers the principle of risk sharing. Musharakah embodies the principle of risk sharing between the bank and economic operators. If the business venture suffers a loss, the bank not only forgoes compensation but also shares in the loss proportionate to its partnership. Conversely, when the venture generates a profit, it is distributed among the participants based on the predetermined profit-sharing ratio. This risk-sharing feature reduces individual partners' risk exposure and fosters collaboration in decision-making. Lastly is the non-interest financing. One of the fundamental aspects of Musharakah is the absence of interest or riba in its financing. Islamic law prohibits lenders from earning profit through interest charges. With Musharakah, financiers can earn a return on their investment without resorting to interest-based financing. Economic operators who adhere to the non-interest concept find this beneficial as it aligns with the Islamic principle and allows them to generate profits while abiding by Sharia. These advantages make Musharakahs an attractive financing option for both Islamic banks and economic operators. It provides opportunity for investment diversification, capital growth, risk sharing, and adherence to non-interest principles. Murabaha, another form of Islamic financing, also offers several advantages to both Islamic banks and individuals or businesses. Let's explore the key advantages of Murabaha. First of all is the utilization of surplus liquidity. Murabaha enables Islamic banks to effectively utilize their surplus liquidity. When an Islamic bank has excess funds, it can use them to purchase assets on behalf of clients in need of financing. For example, if a client wants to purchase an asset, the bank can use its available cash to acquire the asset. The bank then sells the asset to the client at an agreed upon cost, plus a markup representing the bank's profit. This allows the bank to generate profits and put its excess liquidity to productive use. Secondly is the predictable revenue stream. Murabaha provides the selling party with a more predictable revenue stream. In a Murabaha transaction, the profit margin is negotiated and agreed upon at the start of the contract between the bank and the customer. This margin remains fixed and does not change throughout the duration of the loan. As a result, the bank knows in advance the exact amount of profit it will earn from the transaction. This predictability in revenue stream helps banks in financial planning and forecasting. Thirdly is the non-interest financing. Similar to the Musharakah, Murabaha financing operates without the payment of interest or riba to the lender. The structure of the Murabaha ensures that it is free from interest while still facilitating the purchase of assets. Instead of paying the entire amount upfront, the buyer agrees to make monthly payment to the bank over a specific period of time. In conclusion, Murabaha financing provides advantages such as the utilization of surplus liquidity, predictable revenue streams, non-interest financing, and alignment with the ethical and socially responsible principles. These benefits make it an appealing choice for both Islamic banks and individuals or businesses seeking halal financial solution. By incorporating Islamic finance principles, the financial system can promote economic development, income distribution, and social welfare while maintaining the ethical standards.
The next part is comparative analysis between Islamic and conventional banking system. This will help us to understand the characteristics and implications of both systems by looking at their principles, operations and products, and impact on the society. Firstly, the principles. Islamic banking is based on Sharia law, principles that give guidance for economic and financial transactions. Other than that, Islamic banking focuses on profit and loss sharing (PLS) between the bank and the customer instead of using an interest-based model like traditional banks. Lastly, Islamic banking follows an ethical framework that promotes investing in socially responsible sectors and discourages participating in activities that are considered harmful to the society. The main goal of the traditional banking is to increase profits for shareholders by making money from loaning activities. Other than that, traditional banking, the focus is on transferring risk through financial instruments like derivatives and the insurance products. Lastly, regular banking works under the rules and laws of the country it is in. The next is operations and products. Islamic banks offer a range of Sharia-compliant products and services which are designed to align with the principle of Sharia law. Besides that, through Sharia-compliant investment funds, Islamic banks provide investment options. Lastly, the Islamic insurance system known as takaful, which is built on the ideas of shared accountability and reciprocity, is also offered through takaful Islamic banks. Conventional banks offer a wide array of products and services that are widely recognized and utilized by individuals and businesses worldwide. Traditional banks provide investment products such as mutual funds, stocks, bonds, and derivatives. Conventional banks offer traditional insurance products based on actuarial calculations and risk analysis. Lastly is the social and economic impact. Islamic banking has various social and economic implications. In Islamic banking, it aspires to serve a wider range of people, including those who are inclined to religions and favor financial services that adhere to Sharia. Other than that, Islamic banking encourages socially conscious investing and steers clear of industries that are viewed as being detrimental to society. Lastly is their stability. Real economic activity is prioritized by Islamic banking and excessive speculation is discouraged. Conventional banking It significantly contributes to economic growth through the extension of credit, facilitation of investment, and growth of the capital market. Conventional banking promotes entrepreneurship and overall economic growth by offering financial resources to people and enterprise. I will pass the presentation to the next person. Thank you.
Alright, we will moving on to issues of Musharakah. So the first point is disparities in decision making and risk sharing. The equal distribution of profits and losses in Musharakah can be challenging in circumstances when there is considerable variance in capital contributions or level of competence among partners, in addition to the absence of standardized agreements. And according to the Islamic Research and Training Institute, this might make decision-making challenging because partners who are wealthier may have more influence or be reluctant to share risk equitably. Next, the limited accessibility of Musharakah is another issue of this product. So, financial institutions could be reluctant to provide Musharakah financing solutions due to the complexity and potential dangers involved. And according to Shahid 2020, many banks and financial institutions may prefer to offer other, more traditional lending forms like Murabaha or Ijarah because they are thought to be simpler to handle and less complicated. This make more difficult for people and companies to pursue Islamic financial arrangements that are consistent with their choices and beliefs. Besides that, Musharakah can be classified as high-risk product. As a Rabul Mal, which is capital provider, or Musharik, which is partnership, Islamic banks will encounter a variety of risk. Meanwhile, the financial risk, business risk, and rate of return risk are the three issues that may have the greatest influence on how the Islamic bank implements profit and loss. As a result, Islamic bank practice extreme caution while disbursing financing because it is likely that the money came from the depositors who place their money in Islamic banks. And then they anticipate that the deposit money will be held in trust. In the event of future situations, Islamic banks must take the loss and replenish depositor funds. Banks only desire to share profits, which they don't desire to share losses. They are interested in everything that will reduce losses and increase earnings. And the last issue is financing selection process. To handle the business properly and maintain their profitability, while doing so, they must select the ideal partner. Musharakah involves share risk among partners, requiring a comprehensive evaluation of investment, potential risk and returns. Assessing risk associated with market conditions, industry dynamics and the specific venture itself can be intricate and time-consuming. The varying risk appetites and perspectives of partners further complicate the process, necessitating thorough analysis and risk mitigation strategies. Additionally, keeping a careful eye on Mudarib performance will cost the Islamic bank extra money. So they must therefore take care to choose Mudarib who have a great chance of succeeding as well as a lot of expertise and the necessary skills to run the firm. Alright, I will pass to the next presenter. Thank you.
Hello, my name is Jennifer Banisha and I will continue the presentation on the issues of Murabaha. One of the primary issues with Murabaha transactions is the price transparency. The pricing method might not be transparent, which could result in dispute over the true cost of the underlying asset or the markup that was used. Lack of transparency can erode confidence between the parties to a transaction by giving the impressions of injustice or exploitation. The over-reliance on collateral is another issue with Murabaha. Murabaha transactions frequently demand collateral to secure financing. While collateral gives the financial institution a feeling of security, it might restrict access to Murabaha funding for people or enterprises that do not have enough collateral. Potential beneficiaries who might have a legitimate need for financing but lack sufficient collateral are excluded by this criteria, thereby restricting their access to Islamic finance options. Furthermore, Murabaha may also result in a scenario of moral hazard. Buyers who rely on the seller's expertise occasionally may not accurately evaluate the quality or condition of the underlying asset. In the event that the buyer discovers that the asset quality or suitability falls short of the expectation, this reliance on the seller's judgment may lead to disagreement. The moral hazard concern may undermine the Murabaha agreement's legitimacy and trustworthiness, possibly resulting in dispute between the parties. In addition, Murabaha products is also lack of secondary market. Unlike conventional financing, Murabaha financing often lacks a well-developed secondary market. This means that the resale or transfer of Murabaha financing contracts can be challenging, limiting liquidity and exit options for financial institutions. In Murabaha, the paper will represent a monetary debt receivable from the purchaser if the purchaser signed a paper to evidence his indebtedness towards the seller or financier. It cannot be bought or sold for less or more price. As a result, the paper indicating a monetary obligation resulting from a Murabaha transaction cannot create a negotiable instrument. The transfer for the paper must occur at par value.
In Malaysia, BBA home financing concept was introduced by Bank Islam Malaysia in 1983. BBA financing has been introduced by other Malaysian Islamic banks since then. However, BBA financing has been criticized by Islamic finance scholars as it was deemed to be similar with conventional housing loan due to the fixed rate of BBA and the similarity in computation in the interest-based system. An alternative to product is a Sharia compliant financings. SSC in its 56th meeting held on 5th February 2006 resolved that the product of is permissible after Islamic financial institution has been submitted a proposal to offer property financing based on the concept of According to the chronology of implementation of in Malaysia, in Malaysia Islamic banking arena, Kuwait Finance House Malaysia Berhad was the first Islamic bank that offered home financings product based on Musharakah Mutaknikisha contract in 2006. To update, there are 6 finance institutions that offer product based on contract, which are Citibank, RHB Islamic Bank, HSBC Amanah, Afin Islamic Bank, Standard Chartered Saadik, and Public Islamic Bank. In 2015, MOU have been signed by World Bank and General Council with financial institutions for Islamic finance. This MOU is to promote the growth of Islamic bank. Which was based on equity participation contract, allow flexible profit distribution. It also based on declining partnership, which is a split monthly rental depending customer current percentage shareholding. And every written agreement in must contain and state clearly all the terms, obligation, and profit sharing arrangement.
Islamic finance has advanced significantly in recent years and the financial landscape is constantly changing. Musharakah and Murabaha market has undergone a number of important updates recently, demonstrate the industry's dedications to innovations and meeting customers' changing needs. Now, I will present about the progress and new update of Murabaha. In Malaysia, there has been scrutiny of commodities Murabaha or Tawarruk used in Islamic financing, with claims that the structure is planned rather than a true economic transaction. A SME digital finance platform launched its Sharia-compliant trade financing solution based on a Tawarruk despite considerable criticism. As a result of this, the co-founder of funding societies successfully received a Sharia-compliant certificate through a cooperation with Marshad Advising, a registered Sharia advising organization. They believe that by issuing this certification, they will be able to increase opportunities for SMEs and raise their creditworthiness in all categories, varieties and size, including those in the halal market. In a recent development, Citigroup unveiled a brand new trade and working capital financing option based on Murabaha that specifically suits for its corporate clients. Citi New Solutions aim to give corporate clients a cutting-edge and a legal financing options for their working capital and trade financing requirements. Cities hope to satisfy the expanding demand for Sharia compliance financing products in the corporate sector by supplying the Murabaha trade and working capital financing option. This product is a reflection of Citi's dedication to giving its customer a wide range of solutions that are suited to their individual needs. Such initiatives aid in the development and accessibility of Islamic finance solutions for corporate clients around the world as the market continues to grow.
Now, we gotta move to the last part, which is the recommendation and conclusion. The concept of profit loss sharing is considered a fundamental principle in Islamic finance with the potential to stimulate economic growth and prosperity. The spread of knowledge regarding the Musharakah and Murabaha is crucial for enhancing the community awareness and particularly among the individuals with limited comprehension of financial principles in Islamic Sharia. The widespread awareness campaigns and educational programs can be implemented to acquaint the individuals, businesses, and investors with the concept and the advantages of these concepts. In addition to that, the bank has the potential to develop other financing products. They should encourage the creation of new financial products and services that are founded on Musharakah and Murabaha and that serve to the different requirements of peoples, enterprises, and sectors. This involves investigating new markets and areas in which Musharakah and Murabaha may be efficiently implemented, such as the new ventures in technology sectors, initiatives using the renewable energy, and the construction of new physical infrastructure. By embracing the Musharakah and Murabaha, individuals and businesses can benefit from enhanced the financial stability, the shared risk, and a collaborative approach to business ventures. It encourages the entrepreneurship, innovations, and inclusive economic growth by providing access to capital for individuals and entities that may not have traditional collateral or creditworthiness. In short, there are differences between the Islamic and conventional banking system in terms of their guiding principles, modes of operation, and social effects. Conventional banking runs on interest-based transaction, risk transfer, and market efficiency, but the Islamic banking concentrates on Sharia compliance, profit sharing, and ethical considerations. The decision between these systems is influenced by a person, religion's convictions, personal choices, and the legal framework in the various jurisdictions. Making educated financial decisions and promoting a well-rounded financial ecosystem depend on having a thorough understanding of the differences and similarities between these systems. And with that, we wrap up our sharing. Thanks for watching.